All right, hello guys, welcome on. This is the first installment of this series. I wanted to kind of take it easy today and kind of introduce you kind of smoothly in. So I'm going to start in about a minute or two just to get everyone on. I know some of you probably didn't know that I was doing a session so soon. So I wanted to make sure that I put it out there already so that you guys can have something to go by already starting from Monday. So I'm going to start in about a minute or so. I'll just give you guys a chance to get in and stuff. You know, just kind of get things going on there. I guess for next time as well, just to give more space, I'll get rid of the Zoom logo thingy for the live. I'm going to do that afterwards. But welcome as you guys are coming on. I see that you guys are viewing, which is cool. Thanks for all the support on the YouTube channel. It's still pretty new. I guess I can see from the back end that everybody seems to love the robot videos. If you haven't followed me on Insta, my Insta's The Real Money Max. Check it out on Insta. Most recent videos that I've done. Yeah, so I mean, I'm excited to teach. You know, I always teach. I'm always live and doing sessions and stuff like that. But to get the opportunity to kind of go through institutional trading is a pleasure for me to do. So I'm starting off with a 4-part series. This won't be the end of the teachings that I do. I have years and years of teachings and PowerPoints and slides since 2019 at least. I'm teaching. I try to keep it chart-based. I may go through some PowerPoints if necessary, but I kind of wanted to start off with the charts. If it goes in a sense that we need to look at some PowerPoint presentations, then I may do so. I may do so. All right, what's the time now? 3 minutes past 7. Okay, I'll give it like a minute or two more. Just let the live build up a little bit more, and then after we're going to proceed. But yeah, I mean, I appreciate you guys being on. It's good to have you guys. I guess, I mean, in this session, I'll probably take questions at the end, or I may do a part 5, which is really what I'm planning to do, where it'll just be Q&A about trades. I mean, I'm sure some of you have watched the videos that I put out, and they have timestamps that go through the trades that you should be in if you've been following me. I hope you have, because trades have been popping off pretty well. But ideally, you know, the plan is to get you guys to have the opportunity to really gain the best advantage over the markets. And it's my pleasure to teach. I've been trading for almost 7 years now. So I have a lot of things that I can go through and talk about, and I'll be happy to do so. Yeah, so this is fun for me. It really is. All right, so I'm starting in 1 more minute. I wish I had a countdown thing to kind of put it out there that we've got a countdown or something, but I guess there's nothing like that, unfortunately. But I'm going to start in a minute, and then we can go from there. But yeah, so when you're commenting, guys, I would like to know if all of you are from London, where you guys are from. Let me know. Even if you're watching this afterwards, still put in the comments, you know, where you're from, you know, things like that. It's interesting to see and hear from everyone where you guys are coming from. You know, I know time zones are different, so this live session might be like 3 in the morning for someone else that regularly watches the videos. I guess there's nothing I can do about that, but, you know, I want to make sure that everybody can have a good time anyway. So I think what I'm going to do, I do want to share, you know, some aspects of PowerPoints, seeing how it goes. I do first want to make sure that, you know, everybody's comfortable and gets into what I'm talking about. And then after we'll go from there. All right. What's the time? We're 5 past now. All right. Whoa, officially, guys. So welcome to this 4-part teaching series then. I've titled it Institutional Trading, and today's first episode is about where does price come from. Now, price action and using the word price and not the price does have a big difference. And understanding price action, removing that definite article of the means something when it comes to price action, because the reason why I call it price and not the price is because the price is controlled by a group of people. Okay, there's a specific group of people that control price. The price you see on the charts, that goes in line with the news or doesn't go in line with the news sometimes, has a small group of people that control it, which is institutional money. So my idea today really is to go through the foundation of how does price actually behave, what causes price to be the price, and things of that nature. So I want to spend the time to really delve into that. And I will show some examples today. Probably tomorrow, I'll pull up some PowerPoint slides to look at things in more detail, some diagrams and pictures and things like that. I really would like to do that. Okay, so we will do that. Okay. Anyway, let's see how we're doing. I'm going to go through this stuff now and let's have a look at it. So first things first, when it comes to price action, I'm just going to use this charts here. Title is Where Does Price Come From? Okay. Now, where price comes from is important for you to understand a few terminologies. So I'm going to put a few terminologies here. Okay. So the first terminology I want to really go through is what I call price delivery. Okay. Price delivery. All right. So if you're making notes, you can make notes. Okay. Number one is price delivery. All right. Second point that I want to go through is something called the interbanking network. Number two, interbank, or specifically it's called the interbank network. Okay. And third thing I want to go through, okay, is liquidity. Now, liquidity is probably a term that's more common among everyone, traders and non-traders. So liquidity. All right. And then number 4, we're going to go through volume. Okay. Volume. All right. And then the final thing that I'm going to go through is volatility. Okay. Let's go through volatility. All right. So definitely tomorrow I will go through some PowerPoint slides with you guys, so we can take a look at a few things. Okay. Now, when it comes to price action, delivery, volume, where does the price come from? So first of all right, you hear me use the term price instead of the price, and it doesn't mean that I'm grammatically ignorant of the fact that you should put a the when it comes to price. But the reason why I call price and not the price is because price is actually people. Okay, that's the first thing to remember. Price is a group of people. I'm actually going to write that down. Okay, right at the top here. Price equals a group of people. Okay, now I'm going to explain why I'm saying this. Now, when it comes to price action, it comes to how we see price, all of the currencies that we trade, especially Forex market, is delivered from a price mechanism called what we all call price delivery. Now, price delivery has 4 different mechanisms of how it works. Okay, and I'll go through all of the different mechanisms of price is delivered to the market. Okay, how price moves around, what happens with it. Okay, why price does certain things, like goes into a range or does a massive trend or doesn't do a massive trend. Why some days are nothing's going on, then other days all of a sudden the price is just going crazy. I'm going to go through all of that. But the key foundation is that even for those of you who are already traders and you're taking losses and you're not too sure why the price is your stop loss sometimes, and you just don't get why did it go and take stop loss and then go in the right direction. All of these There is a reason for it. And the key thing is to have a foundation about the price. Before I teach anything else, no matter how complex or simple it is, the foundation to understand is price. Okay. So price delivery. All right. Now, price delivery, and I put some little quotes here so that you can put this down. So price delivery underneath here as an answer to A. I'll make it a little bit smaller. I'll put these in blue so that you can see the basically answer and response is the mechanism of how price is fed to the market. Okay, so the price we see, for example, right now, I'm on USD CHF on the monthly chart. We've got 0.89456 for the price. And this price right here is coming directly through price delivery mechanisms. Now, the key is that why am I teaching about this? If you understand the way price is delivered and how it comes into the market, then you're going to have a much better grasp on how to analyze where price is going, and more importantly, understand why the price is going where it's going. Okay. Now, with traditional trading, and I can tell you my story, that for the first 4 years, I lost £4,153.58 when I first started trading. Now, the biggest mistakes that I made was, number one, not looking for a mentor from the beginning. Number two, trying to learn everything on YouTube. Now, it's cliche because I'm on YouTube teaching live right now. But I can say to you that one of the things that I was trying to do was to take every single person's strategy I could find, put them all together, and then try to come up with the ultimate 99% win rate kind of trade strategy or system, whichever you want to call it. And as a result of that, I did have some positive gains. I did have a strategy that was working maybe 60% of the time, but then I noticed that the profitability started to slowly decrease until it became less than 50. Okay, now my risk management wasn't too great either, so that really didn't help the situation at all. But ideally, that was really the kind of the plan of, looking at price delivery mechanisms and price action. That's what I thought I was doing. That was my plan, to understand, okay, how exactly does the price, when it gets here, how do I know that it's going to drop here? What do I do? So again, I had a lot of series of indicators and plenty of indicators. I'm sure I had like maybe 5 or 6. Now, some people say that I wasn't so bad. They had like 10 or 20, on their chart. For me, I had about 5 or 6 at one time. And what I noticed is that, sometimes the strategy will work, but there was just something in the market. It was like as if someone was looking behind my screen, hacked into my computer, and somehow knew the moment I was going to place my stop loss somewhere. And it happened at least 7 times out of 10 where I placed my stop loss somewhere, the price will come maybe within 1 pip of that area, stop me out, and then go in the direction that I knew it was going to go in. Now, literally be smashing things or chucking the, like, what the hell, just shut my laptop, what's going on? And it happened for a while, so, long story short, I met some institutional traders and my mentor who really helped me to understand where I am. Now, I'm a proponent, I'm an advocate for mentorship, because without mentorship, you don't have any measure to know where you're going right or where you're going wrong. There's no barometer. Anything you can't measure, you can't grow or change. And so one thing that I did find is that because I was using my lack of knowledge, or what I perceive to be knowledge, to ascertain okay, this strategy is good and this strategy is not good. Okay, so I'll take this small piece from here and put it here. I was my own barometer, and I wasn't an expert in trading. I had no progress at that time at all, no profitability, hardly, maybe a few hundreds here and there, but not consistent though. So for me, one of the things that I aspire to want to learn, and being around institutional traders that really helped me to be able to do these kind of sessions here for absolute free, and and share with the world, basically, is that pain of loss, and also trying to understand there must be a way. Why does my stop loss getting hit by just about the right amount of pips, and then it goes in the direction I knew the price was going to go into? Now, coming back to price delivery, price has mechanisms of how it's delivered, okay? And the mechanisms of how price is delivered, I am going to go through them now. Okay, so if I was to draw a price delivery circle. All right. And I'm just going to draw some lines here. Now, this is a raw teaching. This is, again, I didn't really design it to be PowerPoint slides, even though I've got hundreds of lessons in slides. I wanted to kind of make it just on the charts for you guys to have it. Now, there's 4 real parts to price delivery. Okay. And within those parts, we can go into deeper detail. My idea really is to make sure that you guys have the fundamental foundation of what exactly price delivery mechanisms look like. Okay. And they come in 4 major ways. Okay. That I identified, sitting down and spending the time to understand. Now, one of the places that I'm going to start with first is not that necessarily the correct order, but just one of the parts that really got me as my own story as a trader. So first things first, when it came to price delivery, there was always a time when the price was in what I call an accumulation. Okay. Accumulation. Now, accumulation is the terminology that I learned afterwards, but the old name that I used to know it as over here was a consolidation. Now, in the course that I do teach, which is 5 chapters long, there was an aspect that I used to teach about the difference between the wording of accumulation and consolidation. Now, when I was taught consolidation, which is stuff that I learned on YouTube, I have no problem saying, along with learning support and resistance, one of the things that I did learn was that consolidation back in those days, this is not what I believe now, obviously, is that it meant, okay, so the old teaching, I'm going to put it here just to make sure no one says, oh, Michael says this. The old teaching was that when the price is in a consolidation, which is basically a range, okay, the number of buyers and sellers were equal. So when the price was in a range, because one of the first things that you probably quickly understand when you get into trading is that not every day is a day where the market is moving, massively. So the old teaching about consolidation here, / accumulation, I'll just put this up here. Let's try and make some space for you guys over here. So this was the old teaching. The old teaching was when you're in a consolidation, it means that the number of buyers and sellers are equal. And when the number of buyers and sellers are equal, the price is in a range. Okay, this is what, okay, I was taught. So I went along with it. So I would try to trade the range. I'll get stopped out of the range, or I'll try to look at the range and see if I can, capitalize on whatever direction is going next. Now, at the time, I didn't really put it into perspective that, with ranges of accumulation, which is what I personally call it, what my academy students call it, and as I've taught them, is basically the birthplace for every movement. Okay, and I'm going to explain to you why. We're still on price delivery, by the way, but this is just one of the foundational terms that I really want you to understand. And I will show some chart examples today too. So the old teaching was that the number of buyers and sellers were equal. Now, what was wrong with this teaching when I met my mentor and then also got into get around institutional traders? Now, one of my friends that works at a very big firm, can't mention the name, but one of the largest hedge funds in the world and one of the largest institutional banks in the world, I'll just put it this way. One of the things he told me is that as a developer as he is, and having a chat about developing algorithms and stuff like that, he said to me that whenever that specific institution is doing data modeling, retail traders are called level 0. When they're trying to reenact the market or reconstruct a period of time to work out what would have happened if they put liquidity here, if they did this and they did that, they call us level 0 traders, which means that we have no effect or impact on the price direction of the market. So the foundational reason why this teaching is wrong, and I want to kind of start with breaking down bad beliefs if you have these. Number one, all right, retail traders, which is us, retail traders, us, do not have the liquidity to move the market, okay? You don't have the amount of liquidity it takes to move the market, especially into a major direction, to move price. I'm just going to put this here. Now, I've introduced the word liquidity slightly early, and I will go through what it means. Okay, so don't be too uncomfortable if you've heard me use that term. I will definitely define what liquidity is in a moment. But the problem with this wrong teaching that I had was that retail traders, which is us, do not have the liquidity to move the price. So my belief was literally that there's people like me behind the computer, all pressing buy. 50% of them are pressing the buy button, 50% are pressing the sell button. And that balance between the two has, in essence, caused us to have a range. The price doesn't have a direction. So in essence, the foundation of my teaching was is that we as retail traders, which I later found out is actually called dumb money or level zero. Now, I prefer to use the term level zero because being dumb and being ignorant, slightly different terms. So I prefer not to use them. All right. So and I will go through the different levels of traders that there are. All right, in a moment. But they call us level zero. Okay. Because the money that retail traders have in the market is insignificant to really cause any overall trend direction or price change. Okay. The price, which I said is a group of people, are a very small group of people compared to the number of actual participants in the market. However, these groups or this group of people have the liquidity that can cause the market to be in one direction or trending. Okay. And so those are the people that you really need to understand how they think, because how do they make money? And this is where you understand where price comes from. So anyway, retail traders, us, do not have the authority to move the price. That's the second thing. So the problem with that is that the assumption is that retail traders move the market. Okay. Number two, all right, the liquidity is not the same as volume. Okay. Now, in the teachings that I had, and this is for me, maybe you guys had better teachers than me, but I need to change this. Make sure it's capital. All right. One of the teachings that I had was that liquidity and volatility were all interchangeable words when it came to trading. So if the day, for example, there was a lot of price action going on, they'd be like, yeah, there's high volume today. That's great for trading, which is not necessarily true. And I'm going to explain to you why, because there's a very big difference between liquidity and volume. So now, I know I've skipped interbank network. I'm going to give you guys the definition for part 3. So let's make some space here. I'll go down here for 5, go down here 4, make this 3. So what is liquidity and what is volume? Before I continue with the price delivery mechanism, you do have to understand this so that you can have a great foundation for the future. Okay. So if I go through here, let's go through what liquidity is first. All right. Now, liquidity is the amount of money, okay, the amount of money in or I'll put per an order, okay, per order. And I'll give you a good example. I'll use the Forex market, but this can apply to different financial markets, okay. Now, I'm going to use this in reference to a candle so that it makes a little bit more sense in a minute, all right. But simple definition, now volume is not the amount of money, it's the amount of orders per, I would say per candle. Let's just put per candle so that it's a little bit better. So amount of money per candle or per, I'll put in an order and per candle. All right, for this one. Now, what's the difference here? Now, volume, okay, when volume is measured in the market, and this is a key here, let's just wait for this to kind of load. Yep. When volume is measured in the market, volume is the number of active buys and sells going on, okay? So I'm going to put this here in brackets, the number of sells and buys. So the number, and I'm going to put here the amount of buys and sells in the market, okay? The amount of buys and sells. So to give an example of the difference between liquidity and volume, I'm going to use an example of a current day. So when it comes to liquidity, first of all, I hope by now you understand that The retail traders do not have the liquidity to move the price. So when price is delivered to us and we see it, how does the price go up by 1 pip or by a point or whatever? What's going on? Well, what moves money in the market is a foundational thing called supply and demand. Now, supply and demand is not the only engine, but it's the primary engine of price that makes the price move from one place to another. So when we look at liquidity, I'm just going to give an example here of when you go to the shops, okay? Very simple example. So I'm going to give 2 shops, okay? Let's call this shop 1, or let's just call it business 1, and then we're going to business 2, all right? Back to what I'm saying. All right, so business number 1, let's put this somewhere, right at the bottom here, nice and easy, all right? So we have 2 businesses, okay? Now, these 2 businesses both sell some sort of product, okay? And with these products, they each have demand for each product, okay? Let's just draw a line here. Simple example. So business number 1, let's look into it. So business number 1, all right, they sell their product and it costs, all right, $100, okay, per item or per item, okay? So if you want to buy one of their products, whatever it is, all right, it costs you $100, all right? That's the price of the product, all right? Now, business number 2, let's go over here, has a product too, and their product that they sell is, let's say, $500, okay, per item. All right. So you have 2 businesses that both sell a product. Okay. Now, what I'm going to do here is that, in fact, with business 2, let's turn it up a little bit. Let's say that their actual product is 50,000 per item. Okay. And you have business 1, which is $100. Now, in terms of their demand, how much people need their product, let's go for it. So the demand for product A, okay, so demand for business 1, let's say per day, let's just keep it to per day, they get a healthy 1,000 orders, okay, 1,000 orders per day. So with these 1,000 orders that they get per day, let's just put this in another color to put this out here. I'm going to put this in purple. So they get 1,000 orders per day. All right. So if we did the maths on how much money they have coming in, all right, it's going to be the number of orders per day times the product. Okay. So that would be 1,000 times $100, which, maths don't fail me now, is $100,000 of revenue. Okay. So $100,000 of revenue is what business 1 achieves from its product per day, right? So let's put this here. Now with business 2, all right, business 2, the 50,000 they sell cars, okay? Now, of course, there is a strong demand for cars, but the demand they have, they sell, all right, just 100 cars a day, okay? Just 100 orders per day. Now, I think I'm running out of space, so I might have to move everything a bit to the left, so I'll do that. That's fine. Let's drag this here. Bring this all the way over here for a minute so you guys can see this. Now, you're probably thinking, we've gone all the way from this deep institutional stuff, and now we'll talk about businesses selling products. Well, the market is a business. And the first thing that helped me and what I learned is that when I come to the market, I'm coming as a businessman. Yes, I'm coming as an analyst, but banks and governments and institutional money see the market as a business because they're trying to put money, they're trying to get more money in coming into their coffers than they put into the market. Okay, so it is a business. So you have to see it the same way. All right. Now let's look at the revenue for business 2. So for the business model and what they sell for business 2, they have 50,000, okay, per item, and they have 100 orders per day, okay? So $50,000 times 100. Now, maths, where are you when I need you? It's 5 million. Okay, so I'm just going to put 5M for short. In fact, let me just put it 4 so that you guys can see this. So they get $5 million of revenue per day. Okay. Now, the question here is, and this will help you to understand where and what prices and why you need to pay attention to it very clearly. So I'm going to put both of these in red. So I've got 2 questions for you, and this way you'll never forget what the difference is between liquidity and volume. Okay, let's make this purple. All right, so when it comes to the difference between liquidity, now in terms of business number 1, let's have a look at it. Let's be business analyst for a minute, so put your business hat on. All right, in terms of the number of orders per day, who has more? So in terms of orders, we know business 1 has 10 times more orders than business 2. Okay, if you were a business analyst and you're comparing 2 businesses, then you would say this, right? Business 1 has 10 times more orders than business number 2, which is a fact. Now, in conclusion, what would you say? That means in terms of volume, all right, business 1 is shifting 10 times more volume, all right? So business 1 has 10 times more volume than business 2. Okay, business 1 has 1,000 products being sold a day, and business 2 has 100 orders being sold per day. All right, that's your breakdown that you're going to have. All right, so 10 times more volume, 10 times more orders. Now, the number of orders you have can also be called the volume, the amount, okay, which is the term volume. Okay, how many orders do you have coming in for your product? All right, now let's do our business analysis. Let's put our hats on again. Now let's look at business 2 in terms of their revenue. Now business 2, okay, we can clearly see is making 50 times more money than business number 1. Okay, now 50 times more money than business number 1. Now money, again, is the liquidity. So another thing we can actually really say is that business 1 has 50 times more liquidity than business 1 in terms of revenue. Liquidity in revenue, to be specific, okay, than business number 1. So these are the conclusions that we can come to. All right. Now, what I'll do, just so that you can see what I'm talking about, I'll just put a slash here. So we've got money / liquidity. Now, if I do that, I'm sure it might cut off the 1, but it's fine. Business 1 has more volume, and we can say instead of volume / here, orders. Okay, it's the same thing. Remember, the market is a business, and I want you guys to always keep this in the back of your head. All right. So we have this here. See if I can get a nicer color for you guys so that you can really see this. All right, let's just make it black over here. Okay, so black over here, and we've got black over here. Okay, so these are the 2 conclusions. All right, I'm going to put this up here, conclusions. The conclusions of business activity. All right. So this side trail that we're taking is important because if you understand this, and you're probably thinking this has nothing to do with trading. Yes, it does. Okay. So if I go over here, let's put this up here. Let's get a dark color blue. This is our conclusions. Now, in terms of volume, I guess you guys would agree. You can comment below watching this that business 1 has a lot more orders coming in per day than business 2, which means that business 1 has a much higher order flow or volume per day than business 2 has. However, if we look at business 2 in terms of which company is making a lot more money, it's business 2. Because even though business 2 has a demand which is 10 times less, so 100 orders per day, per item, they're charging 50,000 per item, they have a lot more, or their clients will probably be a lot richer than the clients of business one. And they'll be making, of course, business two is making a lot more money. Okay. So in terms of liquidity, business two is much more liquidity rich than business one. But in terms of orders, business one is much more volatile, if you want to put it this way, has a lot more volume coming in than business number two. Okay. So if you were a business person and you had to choose what business you'd like to invest in, which one would you choose? Now, for me, I would invest in business number two instead of business number one. Why? Because if I invest in them, I know that per item, I'm going to be making at least 50 times more, possibly, or 500 times more, than business number one. So even though there's a lot of orders, in terms of revenue, there's not as much, nowhere near as much as business two. Now, why am I saying all of this information? Because this is exactly how it is with the market. Okay, business two, you could also call this banks, okay? Institutional money, which is banks and etc. And I'll go through that. Institutional money. Now, when you're looking at price action in the same manner that you're looking at business, because it is a business, the volume of a candle really doesn't mean that much, because again, when you're looking at the market, the key thing you want to understand is that price is a group of people, and these group of people, or what makes up the price, is a group of people or market participants altogether. The people who control the price, okay, are these people on the right hand side here, institutional money. When they're going to put money into the market, their money is the money that makes the market move, not really business one. So even if there's a high amount of volume on the day, on a candlestick, but the liquidity of that candle is not derived from institutional money primarily, then the market is not really going to go anywhere. In fact, most likely is a trap for you to go in the wrong direction. And again, by the time I finish this 4-part series, you understand what I mean. Okay, so coming back now to the price delivery mechanism and my old way of understanding, the old teaching that I had, that liquidity is not the same as volume. Liquidity is the same as volume. I'm going to change this here. Liquidity is not the same as volume, excuse me, was the two things that kind of held me up. So when I looked at a candle, I'll look at a candle and I'll see that the volume is high. So I'll think, yep, that's perfect. That means that the volatility is great. Now, what is volatility? Now, volatility is when the volume or the volume or a barometer of how much volume there is. So I'm going to put this here and measure of how much trading volume there is. Okay. So volume is the actual physical amount, is a number that can be quantified. You can actually, for example, MetaTrader, if you right click over here, you can actually see the volumes. If you press Control L if you're in Windows, I guess it'll be Command L if you're on a Mac, you'll see these kind of green lines pop up. Now, the higher the lines, what that means is that that day there was a lot more volume, or there's high volume. The lower it goes, the less volume there is for the day. That's what it basically means. Now, this is very misleading, because when there was a lot of volatility, my thought was that that's the perfect time to trade, when that's not exactly true. Why is that? Now, when it comes to these group of people, when it comes to price delivery mechanisms, out of the people who trade in the market, the number of actual participants in the market who are retail is around about 86%. And I'll bring you guys the documentation tomorrow to explain to you why it's like that. Okay, as of 2023, about 86% of the market is a mixture of different degrees of retail traders and different amounts of money. Institutions make up a very small percentage in terms of number of participants. As individual businesses, maybe there's, a couple of thousands of them, okay? But when it comes to, and I'll put this here. So if I was to go through the ranges of money that we have, so we have governmental, okay? So if you think about it, each government around the world has their interest in the Forex market, because Each government, each country has their own currency. And in the world today, there's about 208. Okay, so if we were to do the maths here, now this is not exact figures, but this is a very good estimate that you can use to think about how the market is operating. So if we go for governmental levels of liquidity, all right, there's about 208 countries in the world. So we'll say approximately 208. So I'm going to put here 208 participants. Okay. Approximately governmental levels. Now, of course, the individual, hubs and everything of how they trade, of course, will be different. All right. Then when we go to institutional money, which is going to be institutional. So institutional, what I'll do underneath, I'll just put a few lists of different types. So under this can be stuff like, okay, hedge funds. All right, put this here, 10. So we've got hedge funds, we've got mutual funds. Mutual funds. Okay. We've got market makers, okay, in that mix as well. I'm going to put as many as I can. Market makers here. Underneath market makers is continue. We've got insurance brokers, which you probably wouldn't have never thought of that, but insurance as well. Insurance funds, okay. Let's continue. We've got banks, okay. Different types of levels of banks, but I'm just going to put banks as a general statement here. Now I'm going to also put this here. We have banks, including central banks. Now, central banks is a hard one because central banks usually collude with the government. Even though they're supposed to be independent and work with the government, they usually work it. So I'll just put central banks here in terms of institutions as well. Central banks. So if you see it on both parts, I'm going to put a star here, all right, in both places. So central banks is here and is also here because it's always a questionable one, right? So in terms of institutional, I'm sure there's at least for every country, maybe about 300 to 400 businesses as such. So we're looking at approximately 10,000 institutional firms, okay, around the world. And remember, most of them are concentrated in the West. And then they're, of course, in Asia and Africa, there would be, but around about 10,000. All right, let's say 10 to 20,000 around the world, okay? And then there comes us. Now, from where I'm from in the UK alone, there is at least 1 million traders who trade the markets or are actively involved. And this doesn't mean people who just actively trade, it means investment too. People who are on the investment side of things and they don't actively trade. For me, I would say investing is a trading in slow motion. Instead of closing for the day, you close in 2 years, but it's still a trade. Okay, so, and then we have retail. So by mathematics, okay, without having to go into specific details, we're above 1 million for sure. All right, so I'm going to say that we're greater than 1 million for sure, which will be retail. So by mathematical deduction, okay, here, retail, there are a lot more retail traders in the world than any of these other participants. Now, these range of people here from governmental to institutional have a term, and their terminology here, this range here. Now, if I can bring this down, all right, before I continue, I want to use some markings here so that you guys are with me. Now, this live session, of course, I designed it as well for you guys to, of course, ask questions, so you can always ask. But if I was to do something here, all right, I'm going to do a little box here like this. All right, and I'll copy and paste that over here and over here. This range over here, all right, from governmental to institutional is what is called smart money. Okay, smart money. Now, I'm sure it's a term that's circled around. It's quite a standard term to use, so I want to use the term, okay? You could use intelligent money, okay? Now, when the term smart money doesn't mean that these people are just the smartest people in the world. These are the most informed, okay? Most informed. Now, when it comes to most informed, what that means is that knowledge is a weapon. They have the fastest access to data, which is fundamental and price data. Okay, they have access to, they're very well connected within the industry. So by default, coming into trading, these group of people have an unfair advantage against retail traders. Okay, and I didn't know this. Really and truly, I didn't know this. Okay, back in the days, I had no idea in my trading journey that this was the structure of how the market actually is. So these areas over here, from governmental to institutional, are the most well-informed. Now, it doesn't mean they always get things right, okay? But what it does mean is that in terms of understanding or this price delivery mechanism that I'm about to go through, they're the most informed. They drive the price because they have the liquidity to do so, all right? Now, over here, I don't like to use the term dumb money. So I'm going to change the term a little bit because it's not necessarily dumb, because the fact that you're taking a step to get into trading means that you are an intelligent person, because you understand that there's only a limit to how much time for money can work until you need another equation that can help you to get ahead in life. So not necessarily dumb, just uninformed, okay? So I like to put it this way, is ignorant money, okay? Now, ignorance is not bliss, guys. It's very much so, because ask anyone who's blown accounts before, they'll tell you that it's not bliss. Okay, so ignorance, okay, ignorant money, least informed. All right, so ignorant money or least informed, I don't think I have enough space to make it that one, so I'm gonna have to just put it here. Now, what does this mean? Okay, retail traders have the least understanding or no understanding about price delivery mechanisms, the interbank network, liquidity, volume, what institutions are looking for when they get in and out of positions. None of that is known to them. However, the opposite side of the story is that these guys know exactly how retail traders trade. The very strategies that I used to use, trend lines, support and resistance, some concepts of supply and demand, and etc., were all taught from retail to retail. You know, people who are teaching from ignorance to ignorance, okay? And that's no disrespect to anyone, even if you've made profitability, but this is just the truth. Okay, so indicators, well, another thing, which is my third thing I wanted to put here, as to the old teachings of understanding, that indicators are accurate. I was taught that indicators were accurate because they were made by very smart people who were very good mathematicians. Okay. And I found out very quickly after, well, not very quickly, let's say after a couple of years of losing, that indicators, they don't really indicate that well. Okay. So I want you to get this picture if you don't get anything else. And I know that this is the beginning session, so we have writing everywhere, but I want you to remember this concept. Governmental and institutional money are the most informed, what we call smart or intelligent money. And retail traders are ignorant money, least informed or not informed at all. Now, what are they not informed about? How price works, where does it come from? Price delivery mechanisms. Okay, institutions and governments have access to more data by default. And so, as I said before, coming into trading as a retail trader, you're already at a disadvantage. Okay, this is important to understand. You're already fighting a battle that is not a losing battle, but it's definitely not an easy battle. And that's why the figures are so high for failure rate for trading, because although it's an amazing lucrative industry, it's designed by default to put you at a disadvantage. Otherwise, the business will still work, but not as well for institutions, greedy ones, and the governments. Okay, so now coming back to the price delivery mechanism, now that you know all of this, I can clear this all. Now, if you want to take a screenshot of everything, you can do. I'm just going to clear this for clearing's sake so that you guys have something to look at. I told you that I'll answer these 5 things, and I will recap tomorrow. I might actually bring out, you know, some other stuff here, but I wanted to put this all out. So I'll clear all of these charts, and then we can continue. So understanding how price action works is going to be very important for you to understand the price delivery mechanism and the things that I'm going to go over after this. Okay. Now, please advise all of you guys that I'm taking my time speaking as slowly as I can, because sometimes I know I can speak fast, to really take this into your understanding of trading. Now, if this is completely disrupted your beliefs about trading, then I advise that you stop going live if you have to, and just understand these concepts and follow the live sessions as I go along to understand what's going on here. Okay, so in terms of price delivery mechanisms, again, I'll take off the one here. So accumulation. Now accumulation, and I'll show you some demonstrations in a moment, is a range of price action. And I'm going to put this here. Now the new teaching, what accumulation actually is, right here, is the birthplace of trends. Okay. Now the term for trends is an expansion. And my aim is to also break down, terms like these, but a trend or an expansion. And I explain to you why I call it an expansion, or it's called an expansion. Okay. All right. So this is the first thing here. All right. And I'm going to put this in orange. Orange? Nah, purple. All right. So this is the first thing when it comes to price delivery mechanism. Now that you know is a consolidation, now I call it an accumulation, and you'll see why. Okay, so what I'm going to do, I'm going to demonstrate an accumulation, and then I'm going to come back to the second part, and then we'll be moving forward. So if I go over here to an accumulation, now accumulation is a range. Is when the price is in a range and it hasn't moved outside of a range for a while. And you can find them on every time frame. Now, one of the things that I want to make sure that you understand is a term called fractality, which means that on every time frame, the price does repeated mathematical patterns every single time frame. Okay, so and every time frame is connected. Okay, when the higher you go up in time frame is like kind of going up from the ground towards space. You get a clearer and clearer view, a bird's eye view of what's going on. The further you go down in time frame, the more specific you are to enter into a certain area. And this is why, as traders, we look between different time frames, because they have context, but they are connected. You can't disconnect the daily time frame from the H4, from the H1, and etc. Okay, so what I'm going to do, I'll pull up the most famous one that I have actually been going through, and this is on a monthly time frame, but this is a range. So characteristically, what a range is when the price seems to stay above or get to a certain area, never go past it, and then get down to a certain area and never go beneath it, and just kind of bounce between there. So a common range here that I talk about a lot, which is the reason why you should be in USDC HF for a long, from the other videos that I've given you out, is here. Now, mapping out the range of price action, and I'm going to put this here, is within these two ranges here. So if you look at the price action, you can see, now this is over a long span. So this is from 2014 until now. The price has bounced around here for some whatever reason, which we'll go through the reason. I'm just being vague for now. And then dropping down to this area, never going past here. So this is what you would consider to be a range of accumulation. Okay, this is a range. Now I'm going to call it the actual term. It's an accumulation. Now the reason why I teach accumulation instead of the word consolidation, which may be familiar to those of you who are already traders, is for this reason. It's simply because the term itself denotes to what is actually going on from an institutional standpoint, from a price delivery standpoint. And what is accumulation? It's the aggregation of buy and sell orders. Now, immediately, when I first sat down to understand this, okay, it took me a while to kind of get what was going on. But if you notice that this definition I'm giving you, which is the aggregation of buy and sell orders, is completely in actual polar opposite to what I knew before, which was that the number of buyers and sellers were equal. These ranges here, as I've already introduced, that the money that moves the market is smart money, are engineered. Okay, everything that you see about price from every pip to every point, okay, is engineered artificially. Okay, price action is not something that is just left to move wherever. When the price flies up because of news, you know, the highest spike is there for a reason. The lowest spike is there for a reason. Okay. Accumulation is the aggregation of buy and sell orders. Okay. These ranges are designed to aggregate buy and sell orders, or now that I've taught you this new term, increase volatility, not necessarily liquidity per se. I'm not saying that it doesn't, but increase volume of orders. Okay. Now, if we do the anatomy of an order, because this is important for those of you who've never learned trading, this is your first time, or even if you are a trader and you never really sat down to think about what is the anatomy of a trading order. So the anatomy of a trade order. Now, there's different types of trade orders you can have. To be fair, there's about 6. Okay. At least on MetaTrader, there's about 6. But the basic anatomy of any trade order, okay, is number 1 is the entry. Okay. Number 1, the entry price. Number 2, okay, the second part of when it comes to price action is going to be the stop loss price. Okay. Now, some people will call this your stop out level as well. So I'll put that there if that helps. Okay. The price where if, for example, you're taking a buy trade, let's say, for example, here, if the price touches your stop loss, then your broker will pull you out of the trade at a certain amount of loss that is pre-calculated. Okay. And number 3, we've got here the take profit level, or take profit price / level. Okay. And this is where, you know, you hear many traders or people say the R&R. So you're risking 1% to make, let's say 5. So that's a 1 to 5 R&R, risk to reward. This is where this is calculated. Now, there's other parts that are the anatomy of the trade order, which is also important. So number 4 is what is called the lot size, or if you are a MetaTrader student, is actually called the volume. So I'll put volume first / lot size, which means the amount of the order you're taking. Okay. So volume / lot size. 5th thing that's important also to recognize is whether what trade are you trading on? So what chart symbol are you trading on? Chart pair. Okay. And then also we have 6. Now, the key here is that with trade orders, not every trade order you place in the market is necessarily active in the market. And I explain what I mean. Okay. Type of order, pending or market. Now, the difference in pending or market is very important to understand. And I made a mistake many times where I'll set a pending order instead of an active order. And I'll be seeing the price going into profit and I'm so excited. And then I open my terminal and I'm not in the trade. And I'm so confused, like, oh, they're manipulating me again. Trading doesn't work. Not realizing that instead of placing a buy order, I placed a buy limit order. And unfortunately, those two things are not the same. Okay. Now, this accumulation over here, this whole range is designed, okay, for one reason. And I'm going to put a big arrow over here. Let's make this as big as we can, the biggest that's possible. All right. The aim of this is to increase number 6, which is the pending and market orders from retail traders. Now, why is that so? Now, before the market comes out of this accumulation range, which is called an expansion, which we'll go to next, okay, or the price is going to go from no directionality, as I teach, to directionality, which is the terminologies I personally use. This is how the price does so. Okay, it's going to be by accumulating as many buy and sell orders as possible. What for? Well, remember, whenever you have a trade or when you buy something, using our business example again, it would be if I'm buying something, somebody else is selling something, which is how a market works. If you go to the market to buy oranges, somebody has to sell you oranges at a price for you to buy it. Okay. And so what's going on here is that when buy and sell orders are being aggregated, One of the special things that have been built up is number 2, which is your stop loss price. Now, the way institutional money and above make money is by making sure that your stop losses get run, because that is profit for them. Okay, so you can be exit liquidity, as it's called for them. Okay, so this aggregate of volume of orders is not really for the buy or the sell trades itself, is what they're going to be attached to, which is increasing the number of stop losses. Okay, and also pending orders. But I'm going to start with stop losses first. Increasing the number of stop losses. Okay, this is the whole point of what they do, to increase the number of stop losses. Now, because of space, I'm going to make this a bit smaller. So if you need reading glasses, then put them on. Anyway, if I go over here, I'll put this number 2. Yeah, so you've got these 2 things here. So increase the number of volume will indirectly or directly increase the number of stop losses. Now, this is where it gets interesting. So if you increase the number of stop losses and you stop out traders, when institutional money does this, it creates the right amount of, let's put this liquidity balance, so that they can move from being in a range to a direction. Now, the key thing is that institutions will not create a direction or create a trend or increase the directionality from basically net zero to any other buying trend or selling trend without making sure that they have a net number of orders and stop losses and a number of traders in the wrong direction as much as possible also. So accumulation ranges will stay in the same place, whether it's over this period, which is 9 years, or whether 4 hours, or whether 5 minutes, until on the market order book, which I am adding new terms, which I'll talk about tomorrow and the previous days afterwards, they will not change direction or come out of this range, which can be annoying if the price is bouncing between the same area all the time. You know, for those big trends that we want, it won't come out of that range until they've got the number of stop losses, until they have the right amount of volume that they're looking for in orders. Once that does happen, then there'll be what I would call a trigger move. And this trigger move is to set a direction either for a bullish movement, which is the price pushing up, which in this case is going to happen for reasons that I've gone through in previous videos, or the price is going to go for a short. Okay. Now, this is why I said to you that accumulation is the actual birthplace of trends. Whenever the price is in this range, the directionality of the trend is 0. Okay, now the directionality is a term that I've coined to talk about how steep or how unsteep a trend is. Net 0. Okay, so directionality here is net 0. And this is a key here for you to understand what's going on. Now, every trend, okay, bullish or bearish, will always end most times by coming into something of this sort called an accumulation. Now, there are other ways too, but this is one of the major ways. Now, whenever the market has had a very good time, like for example, if I just use a very good demonstration here, you can see from April 2011 all the way until this range started, the price was in a very nice uptrend for 2 years. Okay. Now, when the trend was done, for now anyway, the price has fallen into this range where it's just been bouncing between the same range point, starting from this area over here, where my blue line is, for the last 9. Okay. So it came out of a bullish trend and it's gone into this range. So already, if you think about this, what do you think the price is doing? We've come out of a bullish trend and now the price is ranging. And what does this mean? It's almost like saying that the price is pregnant and is about to give birth to something. Okay. Whenever you see the price in accumulation, it means the market is pregnant. It's pregnant with a new move that hasn't come out yet, but it soon will do. Now, it's been 9 years, so you can say it's 9 months. And obviously, we're in a trade right now that's going to go for a long. Okay. I didn't intend for it to be that way. It just ends up being, 9 years. So now it's time for the market to give birth to a big 9-year-old pregnancy and give us a long. And if you haven't taken the trade yet, I hope you do get in. Please watch the re-entry video from both other sessions, and I'll probably put the link in the description below. But anyway, When we look at the price action anyway here, I want you to see that we're in this range of accumulation and we just came out of a trend. Okay. Now, coming back to price delivery mechanisms, now you know this. And of course, if you have questions, you guys can ask in the comments. I'll definitely answer. What is the next thing? Well, the next thing is going to be an expansion, okay, which I call directionality creation. Okay. So directionality creation, now I don't have the space over here, I don't think. So, okay, maybe I do if I just drag this over here a little bit. I'm getting used to doing that. So directionality creation, put this in black, make that 10. Okay. Directionality creation is the terminology that I use when the price goes from a net zero directionality into a trend. Okay, so trend creation is another term. All right, trend formation. Another terminology that we can use here, all right, would be an expansion. All right, this means an expansion of the range of price. And the only way that that can physically, mathematically happen is that there has to be an accumulation. So the birthplace of all trends, again, the birthplace of price action movements that we see comes from this accumulation range. Okay, this is that part. Now with trends, I will go through trends, but trend direction is when the price has a net overall direction it's moving to. So the directionality is net positive or the opposite. So for example, over here, we can see if I look at USD CHF again, looking at the price action, you can see that the price clearly, although we have the price moving upwards and downwards, the overall direction, you know, in many instances here, is for the price to go for a sell. You can see sell over here and here, and then over here again. Then you have another one over here again. Okay, you can see the price generally is pushing its way short. So you can see we have these what we call bearish trends. Okay, so that is the expansion. Now, if you wanted to dig down, and one of the things I would say is that when you take on these teachings, for you really to grasp it, you're going to have to make sure that you look at the charts and start to map out what I'm showing you. But ideally, this is what you'd want to do. Okay, so we have price delivery. This is accumulation, trend direction. Okay, now after that, we have two more phases that do happen. Okay, and these are also important, okay, to the market. Now, once you have an accumulation and the trend happens, as I said to you, not every single time after a trend, you go back into an accumulation, not necessarily, no. Okay, price delivery has a very specific pattern of how it moves. Okay, and I will continue this tomorrow so that you guys can have an understanding. So the next thing we're going to have here is what I call reversal. Okay, reversal. Now, reversal can be, as the name denotes, a change in direction from the previous direction. So for example, we have a trend here, and the trend is, for example, bullish. And then after that bullish trend, the price reverses and then it becomes bearish. Okay. Now, the extent to which a reversal happens is, of course, a discussion that we'll go through another day. But the key is that reversal means a change in direction from a trend. So I'm going to put this here, change in direction from a change to an opposite direction of previous trend / expansion. Okay. Now I'm trying to make sure I have space so that you guys can see this. I'll put this in purple too, so you guys can know the difference between the question and answer. Okay. So this is the key here that I want you guys to go through when you're looking at the price action. And I'm going to put this in purple too. So price delivery mechanism, as you can see here, and I still haven't gone through the interbank network, which I will do to kind of tie this together. All right. When it comes to price delivery, we have our accumulation. That's the first key there. Then you have your directionality, your trend is created. And then you have the reversal, all right, which is the other part over here that we're looking at. So when you put these things together, then you understand, okay, this is how price action happens. And I need to find out for myself how exactly am I going to get involved in trading or get involved in the right direction? Now, the other thing here that we have now, this is not in order of how it works. I'll go through the order tomorrow. The final thing we have is what I call a retracement, okay? So a retracement over here, right? Now, some people may call this a pullback. So for using colloquial terms to help, I'm going to put here a pullback. Now, even though retracements probably doesn't sound so special, retracements have very important impacts. And you'll probably say, well, pullbacks might, compared to reversals, they sound like the same thing, because if the price is retracing in steps, every time I think of retracements, I always think about the story of the kids that went to the gingerbread house and they were putting out crumbs on the floor to find their way back, you know, so that they can retrace their steps. That's how I think of retracement. And it's something of that sort. Now, retracement and reversal are two different things. And the triggers that cause these two different things are slightly different. And they mean different things in the market. And this is why they're separate. Okay. So when it comes to the price delivery mechanism, this is exactly what we're looking for. All right. These are the four things that happen. All right. The first part would be here. Now, if I was to put numbers on these, okay. So number one, you have this area here. Let's put this here in blue. So number one, we have accumulation. Okay. After the accumulation here, you have a directionality created, number two. After the directionality is created, you have these two here. Now, in terms of numbers, it can be 3 or 4 or 3 or 4. The price can reverse. Now, when it comes to reversal, the key here is that if the price reverses, there's different degrees to which the price can reverse. And what triggers a reversal may not trigger a retracement, or does not most of the time anyway. So you just go around this in a clockwise circle and fall, okay? Now, with these two last methodologies, okay, of how price is delivered to the charts, now price is just literally numbers coming in. The reason why we can actually map out price pretty well is because what is called level 1 data, which is the price that comes in that we see represented graphically, is what we call level 1 data, and all it's doing is representing what's actually going on the market order book. Now, market order books are automatically or automated, okay, using artificial intelligence, okay? So this is where the interbank network comes in. So what is the interbanking network? Now, the interbanking network, as the name denotes to, is a network which is connected with many, many different banks around the world as liquidity providers, okay? The key here is that it's a connection of liquidity providers. The price that we see, the price feed that we get coming in to know what price is doing, comes through or is derived from this interbank network. Now, the discussion about what price is actually the true price and where it comes from practically is a discussion for another day. But for example, ECN brokers, which is the Electronic Communications Network, that's what it stands for, is where connection comes to the interbank network. Now, I'll say this from the start. As I said to you, retail traders, there are quite a few things as retail traders that we have that are, you want to put a chip on your shoulder or a disadvantage. One of them is pricing, okay? The actual pricing that you receive from the interbank network, okay, through a broker to you has had some points added as a premium before you receive it, okay? Now, brokers, the good ones anyway, work as hard as they can for you to get as true or as close to the actual interbank network price and bank price offerings as you can. But of course, to make money, there has to be some adjustments there. So for me anyway, when it comes to the interbank network anyway, we have, so price delivery is how price comes into the market. The interbank network is where the price comes from, where the price is derived from. Okay, so if I was to put a definition to this here, all right, so the interbank network, and I want to write this down over here, is the network of banks and which are liquidity providers, support banks and liquidity providers who provide the price. Okay, so banks and liquidity providers who provide the price. This is the key here. So when you're looking at price action from that degree, then you understand that when the price comes into your brokerage feed, it goes through a channel of different places before it gets to you. So I do want to end with this, and what I'm going to do quickly here is, all right, put this over here. Now, usually for traders, this is what the mechanism looks like. So I'm going to open up another USD CHF. I'm just going to stick on the same chart. All right. And let's have a look at how price delivery happens. So price delivery comes from this network. So I'm going to start from the network. We could go into deeper detail about the infrastructure of the network in that sense, but I don't think it's necessary for this. Okay. So we have the interbank network. Now, with this interbank network, it's going to help you to understand why exactly, okay, and I'll put this here, why exactly there's a price feed, or why exactly price does what it does. So if I put this here, interbank network, all right, so price is delivered, okay, so price. When the price is delivered, where does it go to? Now, in order for you to be a participant in the interbank network, you do need a lot of money. Okay, and this is where brokerages come in. So a brokerage, okay, which is how us as traders involve ourselves in the market. In fact, even with higher levels of money, institutions, they also have professional brokerages that they use, okay, as well. What happens there is that the interbank network and the price that we have, the brokerage, and I'll put this here, is connected to a liquidity provider or liquidity providers. I'll put in brackets, liquidity providers. And then from these liquidity providers, we receive a price. Okay. This is as simple as it gets for now. I'll go through complexities as the different moving parts, by the time you get there. Okay. But the one thing I want you to know is that you're subject to 2 different levels of institutions before you receive the price. Okay, this is important to remember. At least 2 levels. Now, in the perfect ideal situation, it's about 2. It can be more, but usually when it comes to receiving the price, it passes through the brokerage, okay? And then the brokerage passes it to you, okay? So I'm going to put here you. I'll just put the trader. All right, so in that regards over here, when it comes to looking at the price action from here, this is the situation that you're in. You have the interbank network that brings the first price feed here. Your brokerage is connected to the liquidity providers, okay, through different methods that they have or methods that they use. And then from there, you're provided with the price. This is the basic bare bones of what happens with price delivery. Now, in between these parts where price comes to you, okay, number one of the key things to know is that there's obviously going to be a delay. And this is a key thing I want to explain to you. And this is called the latency, to be fair. Okay, the latency speed is, so I put here latency speed. Okay, that's the key thing here. The speed at which you receive the money price of anything, or the currency price, or the price of any asset, the speed at which you receive that price from any data center or wherever is called your latency speed. Now, there's a latency speed between you and the network, and there's also a latency speed between the price originating from this interbanking network and then coming to you. So that delay by a few milliseconds already puts you at a disadvantage. Okay, and this is what I want to introduce to you now. So introducing these things to you now is what I call the algorithm of the market. Okay, the algorithm of the market, I'm going to call it the algorithm of the market, which is called the black box algorithm. Okay, responsible for price delivery. Okay, at least 90% of it anyway. Okay, is what I would say. So 90% is responsible for 90% of deliveries to you guys and to me. Is the algorithm that controls how the market order book works and how price comes in through this interbanking network. Now, this algorithm is not designed to be your friend. It has a few attributes about itself that I'll go through tomorrow. But one of the key things I want you to go through, and this is what in my story, again, when it comes to how price action works, I want to show you. So if I go over here and just quickly show you how it is, okay, over here, we have this key term right here. And the key term that I want to go through right now is something called complex linear regression. In other words, the other term is called machine learning. Okay. So machine learning, complex linear regression, is one of the key capabilities of the black box algorithm, or the algorithm that controls the market, that can control and does control how price operates. And the reason why, if you've been trading and your stop loss keeps getting hit by a few pips and you just don't know why, and you even had the right direction sometimes, this is the algorithm that causes this. It has something called complex machine learning. Now, I want to go through this, but I want to keep these videos short. So I hope you guys are with me so far. I'm going to spend the time to go through what we have over here tomorrow. So I'm going to leave it here, guys, and I'll catch you guys on the next one. I hope you guys enjoyed. Hope to see some